So what is a leveraged buyout? So a leveraged buyout acquires another company by utilizing a significant amount of bond or bank loans. In sometimes as high as 80% or higher. So the equity investors are only contributing 20% or maybe 50%, 20 to 50% of the total deal size. So they're investing much less than they would have if they hadn't raised any debt. And because this is using a significant amount of leverage, as long as the assets value goes up over time, the private equity investors, they receive much higher returns than they would have if they hadn't utilized any leverage. So I've seen many books or lectures on trying to describe leverage buyouts. Most of the books, they have examples. Then we compare it to when we're buying a house. So when we're buying a house, real estate, if the asset's value is $10, and usually in most countries we raise debt. So this asset works as a collateral, and usually the bank lends us some portion of the asset's price. Let's say that the price was $10 and the bank lent us $7, and we've invested our own money worth $3. So this is a 70% debt and 30% equity buyout. And let's say over the time the house, the real estate value increased 50%. Now the house is worth $15, and assuming we have repaid $3 of loan, we have $4 of loan left. So if we sell the house for a price of $15, we will get $11, assuming no tax. So we've invested only $3 and our return is $11. So on a multiple basis, it's close to 4 times multiple. Let's imagine if we didn't use any leverage. If we purchased the house using all of our cash for $10, and in the end if it was $15, our profit would be just 1.5 times of the original investment. But instead, we've invested $3, the return was $11. Now the multiple is close to 4 times X. So by using leverage, the returns gets significantly higher. And this is the leverage effect, and this works as long as the asset's price goes up. However, if the asset's value decreases, we can suffer a significant loss. So that's the downside of using leverage, and that's the risk of using leverage. When acquiring companies, private equities do pretty much the same. We raise a huge amount of debt, and the private equity tries to increase the company's value over time. They implement various strategies. They try to enter the deal as cheap as possible. They try to exit in a very high multiple